Uncensored, the truth about money.
Good day, everybody. How's everyone doing? Welcome to another episode. Welcome to episode number 8. We're still talking about investing. We did say that last week's episode was just an introduction, was just the beginning of something very great and something very nice that we are covering this season. So we're talking about investing, right? And we just did an intro last week. So if you didn't listen to last week's episode, I suggest that you do go back and just listen to it and then follow up with this episode. So thank you so much for joining us. We're very much happy that you're here. And as per usual, I'm with Pratamza, our financial expert. Pratamza, how are you doing, sir?
Mr. Juju, I'm fine, my brother. How you doing?
Good, thanks, man. So we're talking about investing, right? Let's get right into it. So could you please just explain the difference between a high risk and a low risk investment, Pratamza?
All right. So high risk and low risk investment. So what it basically is like self-descriptive, right? Where high risk investments are your more riskier investments where you tend to lose more money, but the rewards. So if the investments do well, the rewards are very great. So the interest rates are very high. So those types of investments, they focus on your asset classes like your equities and your properties. So like, for example, a high risk type of investment would be something like investing, let's say, directly into JSE shares, like buying a certain portion of a company, right? So it's not safe. It's very volatile. It goes up and down. So it's more riskier. So with your low type of investments, so there you're looking at asset classes like your cash and your bonds. So cash is relatively like putting your money in a money market at the bank or a 32-day notice. So the interest rates are not so high, but you're more guaranteed to get your capital back, the one that you invested. So that's basically the difference between the two. So high risk is maybe looking into your asset classes like your properties and equities, and your low risk is looking into your cash and bonds.
Yeah. So if, let's say, how do you then advise a client who comes to you, let's say, who has no idea about investing, let's say myself, ne? I come to you and then I'm saying, okay, cool.
Mhm.
I have this amount of money that I have and I would like to invest, but obviously I would like to see interest and see things happening. You know what I'm saying? Like I would like to see
Yeah.
interest. Which one do you usually advise on?
So, last week you spoke about diversification, right? So you are able to diversify like your investment into different asset classes. So my take is that if you don't know much when it comes to investments, right? You'd put a lot of your portion in terms of investment into something that's low risk, okay? Where Uchina won't lose out on any funds because people who are more accustomed to investments and know the game, through and throughout. They don't mind losing, 1,000 or 2,000 rand. But for someone who is getting into my investments, it's not comfortable for them losing any money. They're looking into getting more money, with what they're putting in. So we'd look into, something that's a bit low risk, but also diversifying a portion of that investment into something that's a bit high risk. Maybe like putting maybe 25% into more of a high risk investment, so that over time, your overall portfolio does yield a bit of interest.
And then how does inflation affect our investments?
All right, so that's a nice one. So inflation, obviously, I get it, is the general rise in prices.
Yes.
So what happens is that with your investment, like what we said last week, is that when you put in 100 rand, like if you're leaving 100 rand today, right, and then the inflation, let's say it's at 5%, next year that 100 rand, because of inflation, right, it'll decrease by 5%. So next year, the buying power for that 100 Rand will be worth 95 Rand. So even when you're investing, it's important to always consider the inflation rate. So if the inflation rate is sitting at 5%, always go for your investments that are a bit higher than your inflation. In that sense, you are able to basically see the buying power of your money and you are able to see real growth. So there's something that we call net interest. So, they advertise, let's say investment, they'll say, all right, this investment yields 8%, for example. But now the inflation rate is at 5%. So your net interest rate is that interest rate that they've advertised minus the inflation. So relatively in real terms, your investment is growing only by 3% as opposed to that 9% if we're taking inflation into consideration.
So, what's the difference between simple and compound interest, and how is each calculated?
All right. So, in simple terms, excuse the pun. In simple terms, simple interest is, so let's put it this way. You put away 1,000 Rand, right?
Sure.
And then with simple interest, let's say it's growing at 10%. So 10% of 1,000 Rand is 100 Rand. And you leave your money over a period of, let's say, 5 years now. So what they do is that simple interest is basically that 100 Rand. They add 100 Rand every single year for that 5 years. So after year 5, Uchuna will be sitting with 1,500 Rand because they've been adding 100 Rand every single year for that 5 years. So now the interesting part about compound interest. So compound interest is basically, in layman's terms, it's interest on interest. So what it means is that, so if let's say, yes, you put away 1,000 Rand and your interest rate is at 10%. So in the first year, Uchuna will have 1,100, right? So what they do is that they don't calculate the interest on 1,000 Rand anymore. Now they calculate it on 1,100. And now Uchuna in the second year will have 1,210, for example, and then and so forth. And then in the third year, they calculated on that 1,210, ganjalo ganjalo. So compound interest is interest on interest, whereas simple interest, as like what the name means, it's relatively just the interest rate that they add, or that initial interest that they add on a yearly basis.
Sweet. So, Tami, I want to know, is it better to invest your money at a bank or invest in companies?
Yeah. So what happens is that with banks now, what they've done, right, is they've started teaming up with these investment houses. But with that being said, it is better to put your money away with an investment house or get a financial advisor who will be able to to advise you better in terms of putting your money into greater rewarding investments. So with banks, what they literally do is they trying to safeguard themselves and try to safeguard the funds that you have put in. Whereas with your investment houses, they try to get more return for Uchunia. So for them, it's a business that they're running from them, getting more interest rates out there. So with banks like have your money markets, they have your 32-day notice, so the interest rates, they're very quite low. So that's your low risk in types of investments. So I wouldn't really suggest to put, all your money into like a savings at a bank. Yes, put a bit of it in there. Like, as I said, that try to diversify, put a bit in there and put some in your investment houses. In that way, at least you know that if, let's say, your investments in the investment houses don't go so well, you've got some safe money in your commercial banks that you bank with. So, what I recommend is that rather speak to like a financial advisor who will advise you better in terms of investing your money into other investment houses like your unit trusts. There's like offshore investments, investing in ETFs as well. So there's quite a variety of investments out there, as opposed to like your money market and 32-day notice, because that's what people know. You open a bank account, and then on your app, what appears is a savings pocket. Put money away. So yes, those are nice to get into the hang of investing. But once you want to grow your money even further, it's better to speak to a financial advisor who will then advise you into diversing your portfolio even better. Like as I said, looking into offshore investments and other investment vehicles.
So my next question is, or rather, not really a question, but would you mind just giving us 5 common mistakes that investors make?
5 common mistakes that investors make.
Yeah.
So, so this will be okay. Number 1, a lot of people do not get much information. So that's the first mistake that people do. They don't do much research when it comes to investing, right?
Yeah.
Number 2 is they want instant gratification. So basically, I want to put 1,000 rand now, and I want 2,000 rand in December. So people want like quick rich schemes, and that's how a lot of people fall victim to all these Ponzi schemes that are popping up here and there. All right. And then number 3 as well is that once people have invested them funds, right, they don't do reviews of their portfolios. So they don't even know how their portfolios are performing. So I've met up with a financial advisor. Yes, it is their duty to contact me on a quarterly basis or 6-month basis to review my portfolio. But I, as a client as well, I need to be, accustomed to what's happening with my investments. So that's another mistake as well. Number 4 is when people, choose a certain strategy, investment strategy, or a certain investment vehicle, and they lose out. So let's say, for example, I put money away for 5 years, right? And then in year 2, my portfolio drops just a bit, right? So the mistake that people do is that they want to change their investment vehicles or their investment strategy because they've lost out on a few rands, and not looking into the overall picture of, let's say, putting that money, just sticking to the 5-year plan. So that's number 4. Number 5 is once people get to the maturity of their investments and they get, let's say, that certain lump sum out, what they do is that they don't now, let's say, take out the interest and keep on reinvesting. So what most people do is that they take out that money and they go spend it. But now, forgetting that, with that that term that we used earlier on, compound interest, that your money can still keep on growing if you're just leaving it in there, for a longer period of time. So that's why last week we covered on, like the principles or the discipline of investing, which is important to make it a lifestyle. So once people get to that 5-year term, they take the money out, and then they don't have any investments after all. So my thing is that just keep on putting the money away and leaving it in there. Let compound interest do its magic, and over a certain period of time, you'll see the rewards will be much better.
Sweet. So, so your point number 3, you spoke about that people do not review their investment portfolio. They leave everything basically to their financial advisor. I just want to know, with that, is it possible that you can find yourself working with the wrong financial advisor? Not maybe, I don't know, maybe wrong is not the right term, but you get what I'm saying.
Yeah. So put it this way, my man. In every industry or any faculty or field, there are those people who try to con people out. So with insurance, what's dangerous is that because customers do not know or haven't done their research, they don't know much of what's happening in the industry. Like with regards to how much a financial advisor can charge you, looking into different products as well. So a financial advisor, when it approaches you, irrespective of which product they sell you, they should basically give you, 3 to 5 different products and the advantages and disadvantages of all those products that they give you, right? Number 2 is that if a financial advisor is not great, you'll see basically by them frequently contacting you. So if I've placed, let's say, R1,000,000 with Junior as my financial advisor, and Junior took, let's say, 3% upfront, but now Junior is not contacting me after 6 months or after a year. So Junior was that one hit wonder. He came, he sold that product, and he left. So that for me is a bad and incompetent financial advisor. And also, financial advisors should basically also tell you about, new things that are happening in the industry, because they are there to advise you. So they should basically keep you abreast of, Junior, this is what's happening with your investments, or these are new investments that you can look into. So it's an ongoing relationship. So it does not end when the sale is made. It basically continues even after the sale is made. So those are some of the few key points that you can touch up on, or that you can highlight when you see this is not going well. But also as well, you have the right to change financial advisors as well and cancel that relationship with the current one. So yeah, so those are basically some of the few points, but we can speak for days about that.
Definitely. So thank you so much. This has been, I think this has been very much helpful. Thank you so much, Tamza. Thank you everyone for listening. Please remember, you feel free to send any questions. If you do have questions, if you feel like we haven't answered a certain question, if you feel like there's still a lot that you'd like to know and you're not really sure where to start, this is the right platform to do that. Please send us your messages on our Instagram page, uncensored_the truth about money. And please, guys, so we do our episode each and every single week. So if you want to be reminded, please, whichever platform you're listening from, whether be it Spotify, Apple Podcast, or Google Podcast, please just subscribe so that each and every single time an episode comes out, you can be notified. Thank you so much for listening. Thank you so much, Pratamza. Thank you.
Cool.
We love you guys. Bye.